You'll want to hear what Jamie Dimon has to say regarding the future of the real estate market and the economy if rates rise and there is a recession. There will be real estate problems, and certain banks will have far worse real estate problems than others. As the CEO of J.P. Morgan Chase, one of the biggest and most influential financial firms globally, with $3.7 trillion in assets under management, Dimon has unparalleled access to insider knowledge of global economic developments, which is why I was drawn to him. What is your opinion on commercial real estate? In a recent interview, Dimon talked about the crisis that is developing in the U.S. real estate market. Approximately half of the $929 billion in commercial multifamily real estate debt that will mature this year is owned by banks, primarily regional banks. The remaining portion is either securitized or owing to non-bank lenders. We've also seen a recent decline in property prices and higher default rates in some areas of the market. And when asked if he believed that the next credit catastrophe will ultimately stem from stress in commercial real estate, he responded, first of all, put commercial introspective with consumer. The consumer markets are much larger, so what occurred in 2007 or 2008 is not the same kind of situation, and many of these business owners are able to bear stress. Therefore, Dimon states that he will take a brief break from discussing the financial system because some of the infrastructure, such as warehouses, data centers, and hospitals, is truly well done. But offices have less value if you only take them. Because whenever you own with cash flow is worth 30% less when interest rates rise by 300 basis points. So people realize that's not a catastrophe. On the other hand, while a recession will undoubtedly worsen, we don't actually have one. According to Dimon, most people will be able to get by with this. Refinancing added more equity, for example, and default rates rising naturally because they were so low for such a long time. As a result, credit is increasing, but it's not a crisis point. Rather, it's just returning to normal. Yes, there will be real estate issues if interest rates rise and there is a recession. However, as you evaluate the landscape and regional banks, there will be more of a whack-a-mole effect than a domino effect. As long as the economy continues in this direction, there shouldn't be any domino effects. Instead, the issues you've observed are primarily local. For example, when you discuss real estate, First Republic, Silicon Valley, and New York Community Bank are just a few examples of the idiosyncratic problems that exist within these banks. If I call it an office, I have fantastic leases in it. However, it is fully leased out with 20 leases that are quite different from the specifications, so you really have to look deeper. We make an effort to accomplish so by looking at credit and determining where there will be pockets for many generations. Real estate in the United States has been regarded as an exceptionally secure investment. It seemed as though buyers could never lose money on real estate, even if they chose to purchase in, let's say, less desirable neighborhoods. A major factor contributing to real estate's exceptional performance over the majority of the last 50 years has been interest rates. Consider this a stand-in for interest rates in the economy. Interest rates reached their high in the 1980s and have been steadily declining ever since. In fact, interest rates have been down for more than 30 years. The capitalization rate, or cap rate, is used to value commercial real estate. In short, a cap rate is simply the rate of return an investor expects for a property based on the income that property is expected to generate. The CPR formula is very straightforward. Decades of declining interest rates acted as jet fuel for real estate, pushing values to the stratosphere. Simply take the anticipated revenue from the property and divide it by its value. For example, if we have a property that will bring in $80,000 this year and it is valued at $1 million, we can calculate the cap rate, which in this case is 8%, by dividing the annual revenue by the property's value. The cap rate increases with the amount of income compared to the property's worth. Conversely, a lower cap rate corresponds with a lesser income in relation to the value of the property. Recall that the cap rate is only a gauge of the return on investment for an investor who buys a property at a specific price. Interest rates are one of the main determinants of the cap rate that investors are ready to pay on a real estate investment. But let me introduce you to John to show you what I mean. After years of hard labor and savings, John is now in a position to invest the money he has built up. For the purposes of this example, let's pretend John has two possibilities. What John should do largely depends on the return he can get from either of the two options. Either he keeps those savings in his bank account generating interest, or he buys a house. In this scenario, John would logically choose the savings account because the bank is offering him a 10% interest rate on his savings, and the investment property is anticipated to yield a 10% return based on the current price John would have to pay to purchase it. Compared to merely having your money in a bank account, owning real estate has a lot more risk. Things can break and need to be fixed. Renters may stop paying rent, or your property may eventually lose value and cease producing as much income. Due to this increased risk, investors require a larger return before they will consider making a real estate investment. For the sake of this example, let's pretend that the extra return requirement is 5 percentage points higher than what can be gained in a savings account. This means that before John would even consider an investment property, it would need to yield 15% annually, with the savings account yielding a 10% return. If the interest rate on the savings account drops to 7%, observe what happens when the interest rate that the account offers decreases. John's real estate investment now requires a 12% return. If you increase the savings account rate to 5%, John will only want a 10% return on the property. If you decrease the savings account rate to 0%, real estate will appear appealing and yield a pitiful 5% return. Of course, this is all hypothetical. When real estate investors were willing to accept lower cap rates or returns when it came to purchasing property, the example serves to illustrate exactly what has happened since the 1980s. You're going to see exactly how these lower and lower cap rates send real estate values skyrocketing. Let's return to our earlier property, which brought in $80,000 a year at a 15% cap rate. At that point, the property was worth $533,000. If we go all the way down to 5%, the property's value soars to an astounding $1.6 million. Taking the cap rate down to 12% brings the value up to $667,000. The only thing that changed over time was investors' willingness to accept ever lower returns, which in turn drove real estate values to ever higher prices. However, things are now turning around, with interest rates shooting up to their highest levels in 20 years, which could have disastrous effects on the real estate market, leaving property owners underwater on their loans and banks stuck holding the bag. As an example, consider an investor who purchased an apartment building at a 3% cap rate during the height of the real estate bubble. Interest rates were extremely low at the time. Thus, this 3% cap rate would have appeared totally acceptable. Using our earlier formula, let's assume for the purposes of this example that the apartment building generates $100,000 in annual income. We can determine the building's value, which is $3.33 million at a 3% cap rate, by dividing the annual income by the cap rate. As with most real estate owners, our investor here bought the property through a loan. In this case, the loan amount is 70% of the property value, or approximately $2.3 million. Now, instead of using a 3% cap rate, let's observe what occurs when interest rates rise and cap rates rise. This property was bought with a significant amount of debt. Our investor has a $2.3 million loan on a property that is now only worth $1.66 million. This is what it looks like to be what is referred to as underwater on a loan. The asset used as collateral in the loan falls so much in value that the borrower owes more money than what the asset is currently worth. Let's say the cap rate for this building increases to 6%. Instead of $3.33 million, the building is now worth $1.66 million. The cap rate doubling caused the property value to be cut in half. According to Jamie Dimon, in this scenario, the real estate investor would probably lose everything, and the bank that provided the loan would have to absorb the legal loss. Whether or not conditions as dire as these spread throughout the real estate market largely depends on the state of the economy and interest rates. Pay attention to Dimon as he describes what he observes, although markets tend to change their minds somewhat fast. Confidence is currently rising more than it has in the past. The yum and chatter equity market is opening somewhat, and spreads are approaching historical lows, indicating that a lot of money is pursuing high-yielding investments. It seems that the current state of affairs, with open markets and great consumer confidence, contradicts your more pessimistic outlook. According to Dimon, the base case for inflation may still be stickier rates than the markets anticipate, which is what's kind of feeding the current tone of caution. Dimon made this statement in fourth quarter earnings last month. The way I look, you have to look forward, and I do believe there are things out there that are sort of troubling to keep an eye on. In 1972, you felt wonderful too, and before any crash, you felt fantastic. However, things changed after that. And so, one of the main reasons we're doing so well is because of fiscal spending, which also has a multiplier. Therefore, I just think it might not go down that quickly and people might be surprised. For example, when people talk about how the market is kind of pricing a soft landing, that could very well happen. But the odds are 70 to 80% that Dimon would give in half of that, which is all 7 or 8 rate cuts. Additionally, Dimon believes that focusing on any one year is always a mistake. All of the variables we discuss, such as key fiscal spending deficits, geopolitics, and other issues, may take several years to resolve, but they will eventually come to pass and have an impact. We just don't know what that impact will be. Higher interest rates have an influence on real estate, but they also have a depressing effect on the economy as a whole. To illustrate what I mean, consider your favorite neighborhood restaurant in your city. I'm kind of hesitant about what you're hedging. For the purposes of this illustration, let's say the owner of your favorite restaurant loves the experience his patrons have at his establishment and would like to expand to accommodate more people. However, the restaurant business is notoriously difficult, so even with constant effort, it's likely that the owner doesn't have a lot of money lying around to open a second location. A survey conducted among restaurant owners revealed that the cost of launching a single outlet might range from $175,000 to $2 million. Due to the substantial financial requirements, the restaurant owner will have to rely on a loan from a nearby bank in order to create the second store. For the purposes of this example, let's say that opening the second site will cost $1 million. Whether or not our owner can afford to grow will be greatly impacted by the interest rate on that loan. Assume for the moment that the owner is able to obtain that $1 million on a 10-year loan with a 3% interest rate. The loan payment for that loan is $965 per month. The monthly payment increases to $1,610 if we increase the interest rate to 7%. Since restaurants have extremely narrow profit margins, as we previously discussed, the monthly payment would skyrocket to $14,347 if the interest rate were to increase to 12%. The statistics behind building a second site soon become nonsensical when thousands of dollars in additional loan interest must be paid. The opening or closure of this second facility will have an impact on the whole economy. If it opens, consider all the good things that will happen to the economy. Local contractors and tradespeople will have more work as they refurbish the property to get it ready for the grand opening. And new employment will be generated for the servers and kitchen staff who will be employed. This is just a simple example, but it helps illustrate why low interest rates are stimulative for the economy at the moment. While many people believe that interest rates will definitely decline in the not-too-distant future, Jamie Dimon is more skeptical and believes that lower interest rates are far from guaranteed. The outcome will become clearer with time. And it doesn't end there. All of the companies that sell the furniture, linens, uniforms, and food needed at this location will get more business. The list goes on and on. You get the idea. However, one thing is certain. The real estate market could have severe difficulties if interest rates stay high or even rise. In conclusion, the real estate market is showing signs of a looming crisis, with factors such as overvaluation, increasing interest rates, and economic uncertainty contributing to the uncertainty. As investors, it's crucial to stay informed and vigilant in monitoring these developments. By understanding the dynamics at play and taking proactive measures to mitigate risks, we can navigate through these challenging times and emerge stronger in our investment endeavors. Don't forget to like this video, share it with others who might benefit, and subscribe to our channel for more investing tutorials and market insights. Thank you for watching.